point. We show here the blue line is the performance of the stock market in the 08-09 downturn indexed to the pre-recession peak of the S&P 500. And you can see it was a long grinding downturn for stocks, reflecting the long grinding downturn in the economy, and then a very difficult staggered return to old highs that took many years to complete. Contrast that with the green line. That's our current experience, and we had an incredibly sharp downturn, but then an incredibly robust, rapid upturn. We think this reflects the fact that we went into this cycle with none of the fundamental underlying economic imbalances that mark most cycles. Typically, you have an excess of something that has to be squeezed out of the system. In 08-09, we had an excess of leverage in the financial system, and of course, we had an excess of inventory in the housing market. It takes time to work that out. When you take all that grinding time of squeezing out those excesses, you do a lot of damage to the economy, which takes a long time to repair from. This time is different in the sense that we didn't have those imbalances. So in theory, this could be an on-off switch for the economy, where the shutdowns, the pandemic-induced shutdowns, whether government-imposed or self-imposed as prudent measures for protecting one's health, once those challenges pass, in theory, you could get back to where you were very quickly. This is an oversimplification. There has been damage done to the economy, and that's really the substance of what we have to talk about today. But it largely reflects reality. There are no great excesses that have to be wrung out of the system. We should be able to get back, if we could address the healthcare concerns, we should be able to get back rather quickly. Also, keep in mind that what the stock market is telling you is not reflecting current conditions, but future conditions. And the way this works is stock market prices come back before earnings come back. Earnings will come back before GDP is fully restored to its old high, and GDP will come back before the labor markets heal and we're back at full employment. One of the reasons that this cycle has seen a fairly robust recovery, at least up till now, it's not a complete recovery, but a good bounce off the bottom, is because the way the traditional cycle that grinds an economy lower in a recession was interrupted. The Federal Reserve's quantitative easing, the asset purchase program, helped prevent a loss of liquidity in the markets. That helped prevent a true spike in yields, for instance, in yield spreads, which would have encouraged insolvency or put excess burdens on business. You had fiscal stimulus supporting this. You had the Paycheck Protection Program supporting consumption, as well as the expanded unemployment benefits. So all of the things that normally spiral an economy lower were not completely arrested, but they were at least somewhat cushioned by this action. What's truly remarkable about this action is the size of it. If you look at the stimulus measures, the fiscal stimulus measures, the way to judge those is relative to the overall size of the economy. And we've got a couple of large fiscal interventions in our economic history. The bar on the left reflects the interventions of the Great Depression of the late 1929 and mostly into the 1930s. For all we learned in the textbooks of the Civilian Conservation Corps and the Work Progress Administration, all of those interventions added up to only about 5.7% of average GDP over the period. So it was large, but really, given the depth of the depression and given the decade-long length of the depression, perhaps certainly not large enough to have really arrested that difficult, challenging period for the economy. In 08, we got off to a slow start. We did start to get some intervention in place, 1% of GDP. In 09, we had a much more pronounced intervention, 5.5% of GDP. So in total, the great financial crisis, the 08-09 recession, we had 6.5% fiscal stimulus relative to GDP. Look at how that compares to what we have done to date, and perhaps there will be another stimulus measure. Now it's looking more likely to be post-election and perhaps into next year. But already in a period of months, we put into the economy 13.5% of GDP in the form of fiscal stimulus. We have no precedent for that in our modern economic history, and we do think it played a positive role. One way to see the way that all these interventions helped would be to look at things like high yield spread. This chart, you'll see a shaded gray vertical area, sort of an industry convention. Those are periods of recessions. You'll see that yield spreads in 08, 09 got up to nearly 20-fold percentage points. And then we had, of course, a couple of scares along the way, the government debt crisis and downgrade of US government debt in 2011, that spiked up to about 7.5% yield spreads. The collapse of oil prices in 2015, another spike up to 7.5%. And then this crisis, the pandemic, we did very briefly get beyond that 7.5% threshold, but we never really saw yield spreads up above 10%. This is a reflection of the power of these interventions, whether fiscal stimulus or whether asset purchases, to help stabilize the markets. And of course, when we now have spreads roughly in line with normal levels, which helps alleviate some of the burdens on corporate America. So it's played an important role in this way. Of course, we still have a challenge of unemployment. And again, we've seen an improvement, an improvement off of the really dramatic spike in unemployment. That spike actually understates the fact that people who were furloughed inaccurately reported on the surveys that they were not unemployed. They were unemployed. They should have been included. It probably would have taken the peak of unemployment up to 17, 18, perhaps even as high as 20% just a little bit earlier in the year. The federal government has figured out how to get beyond those problems with their survey results. So our current numbers are actually pretty accurate. Still a long way to go to full employment, and we would argue at Fifth Third that this next patch is going to be much tougher to achieve, but that's an impressive level of recovery. And it's also important that that recovery happened rather quickly. If you take a look again on the left-hand side, let's spend a moment on the Great Depression. You'll see in the 1930s, for basically the whole decade, we had double-digit unemployment. It's not just important for an economy how high unemployment gets, it's how long it lingers, how long it lasts. And that was a devastating factor in the 1930s for the economy. We have alleviated some of that this time around, but we're going to argue, and I'll show you some charts later, that this is going to be a concern, although of a lower magnitude, but this is going to be a concern for workforce growth and hence economic growth going forward. One of the things that helped make the spike in unemployment less painful for the overall economy, and of course very painful for those who were part of this, but the layoffs, the layoffs and temporary or permanent tended to be focused disproportionately in lower earning quintiles of the economy. And the bottom two quintiles of the economy are only responsible for 11% of income in the US. We're a consumption-oriented economy. These were not of course, the large spending components of the workforce. Contrast that with the top two quintiles of income earners. Those are ones who disproportionately were able to work from home and keep their jobs. They're responsible for about 75% of income and hence most consumption in the US. So these unemployment numbers were quite horrific. They were, of course, very painful for people involved, and that pain is far from over. But in terms of the impact on the macroeconomy, it was less than one would expect from those high unemployment numbers. And part of that was the CARES Act supplemented unemployment income in a very, some would argue, excessive way. That subsidy, which has expired, permitted a $600 per week supplement to existing unemployment. The chart you see before you comes from a paper published by the National Bureau of Economic Research, and it shows the impact of the CARES Act subsidy based on income quintile. So the income decile, 10% units. The left-hand bar is the bottom 10% of earners. The blue line shows their unemployment, the average unemployment benefit they could expect relative to their previous income. which is the 100% line. So you could see that, roughly speaking, unemployment insurance provided about half of their previous level of income. And that's true for roughly the first 4 or 5, even 6 deciles of earners. But when you added on that $600 per week subsidy, the actual earnings in the case of lower earning deciles were higher than their employed earnings. So again, let's look at that left-hand, most left-hand bottom decile of earners. Without a subsidy, the blue area shows that relative to that 100%, their previous earnings, they were receiving about half. But when you include the $600 per week subsidy, those bottom 10% earners were making nearly 3 times as much while unemployed as they were employed. Now, obviously, that's bad policy to keep in place for the long term. It has expired. There's an effort to develop a new subsidy by presidential order. We've got sort of $300-400 subsidies out there, depending on how they were adopted on a state-by-state level. But the point here is that those subsidies were very effective in cushioning income losses due to unemployment. Of course, all of this is going to be a function of how we can move from here on our health outcomes. And the starting point for us and the metric that we focus on is hospitalizations, because hospitalization problems and running out of hospital capacity was the original justification for the lockdowns. Remember the flattening the curve concept of let's spread out these infections over time so that we don't overwhelm hospital capacity. And if we were to see an enormous spike of need for hospital beds due to COVID-19, we might start taking into account more drastic measures. We don't believe a lockdown is likely, but people's behavior changes. So this is a very important measurement for us. There are really two humps here. The first peak, of course, in April was predominantly New York City. About half of those beds were the New York City area. And that was a fairly narrow geography to have this many hospitalizations. And it was really at risk of overrunning that system. Never got there. You may remember there were a field hospital set up in the Javits Center in New York City that never really got used. And then gradually hospitalizations came down. The summer spike that we saw was spread out across most of the 49 other states. And so although the numbers were close to the spring peak, there was nowhere near the stress on the hospital system. There are pockets here and there. We raised this issue because we do expect growth in infections as we enter the fall and winter months. But you can see that hospitalizations are still relatively low compared to the peaks, that we have room, and that even the summer spike really didn't come close because it was so spread out to overwhelming hospital systems. Hospital systems have by and large also built in a lot of flexible potential capacity since they use it. But it's something that we think needs to be watched. And of course, we can't expect a full return to pre-pandemic normal until we can see this disease more fully eradicated. So of course, that's our starting point for where are we going. There are, of course, no vaccines approved for use in the United States. There are a couple approved, Russia, China. We don't know the safety and efficacy of those vaccines, so we focus on the US numbers. And as you know, a number of those trials have been halted for safety reasons. They'll probably resume. That's good news. It means the system is operating as it should, working through. There appears to be no rush to get a vaccine out before it's ready. But even if one were to become ready, and we think it's increasingly likely that there will be something ready for limited use at year end, maybe for healthcare workers and for senior citizens, those most vulnerable, we're still a long way off from widespread distribution where we could really eradicate the risks of this, largely eradicate the risks of this disease. So we're a long way away from a vaccine being able to really change our overall picture in the economy. However, there has been and continues to be progress in treatments, antiviral drugs, antibacterial drugs, plasma treatments, and improved protocols that are having a positive impact so that infections don't have the same degree of hospitalizations, critically hospitalizations don't have the same degree of mortality associated with it that we saw in the early days. We're learning, it's good, we're having better health outcomes. But we do think this rise of infections and some degree of rise of hospitalizations is likely, but we'd also push back against the idea that it's doomed to be a disaster. The IHME, one of the more accurate forecasters, recently cut their expected mortality roughly in half. There is likely some kind of wave coming as people move indoors in the colder weather states. As there tends to be some seasonal vulnerability to diseases like this. But people tend to overblow the risks of a second wave. They do that because of the history. The great influenza pandemic of 1918-19, often called the Spanish flu pandemic, came in 3 waves, and the second wave was the most deadly. This was an incredibly deadly disease. Over 600,000 Americans died of this over the course of it, and a stunning, according to the CDC estimates, a stunning 50 million people around the globe died of it. And the worst part of this was the second wave, which came in the fall of 1918. So people are analogizing that experience to today. We think that's the wrong thing to do. For one, of course, 100 years of medical advances, but also you have to look at the context of the second wave of the great influenza pandemic. World War I was still on. Try practicing social distancing and good hygiene in a trench in France. Then when the armistice was signed, ending World War I, famously on the 11th hour of the 11th day of the 11th month of 1918, you had massive troop movements, often in crowded troop trains or troop ships, spreading the influenza in late 1918 and into early 1919. People have pointed out that we were a more rural society then, so perhaps we should be more at risk in today's urbanized setting, but that's not wholly accurate. In aggregate, we were a more rural society, but within the cities themselves, conditions were far more crowded. For example, the island of Manhattan, the largest borough, the most populous borough of New York City, in 1920, the census data year we have information for, 1920 had 1 million more residents than today. People were packed into tenement type housing, often with limited hygiene facilities, and often multi-generational living, things that we know help encourage spread of diseases like this. And then finally, public transit, we know has been a spreader in many ways. Certainly New York City had this experience. One of the things that's really interesting to us at Fifth Third is that public transit ridership in the United States, in absolute numbers, not just relative to population, but in absolute numbers, public transit ridership in the United States peaked in 1926. We are much more of a car society today. That means the spread of disease through public transit is a much lower risk today. But we are going to have consequences. And the consequence we probably worry the most about in economic terms is the threat of the growth of long-term unemployment. Long-term unemployment is actually a technical term defined by economists as 27 weeks or longer of unemployment, roughly 6 months. And what we know from experience, at least, is that when you hit the 6-month mark, bad things start to happen to the unemployed in terms of their ability to re-enter the workforce or re-enter employment. When you get past 6 months, you are increasingly more likely to drop out of the workforce. One of the reasons is you have a decreasing probability of being called back for job interviews. You have a decreasing probability of, even if you are employed, having that employment stick. And there's a very clear correlation between the longer you've been unemployed, once you're past that long-term unemployment mark, the longer you've been out, the less likely you are to recapture your old earnings levels. You take a progressively greater haircut on earnings. Why are we talking about that today? You can see this chart is the percentage of those unemployed who have been unemployed long-term, 27 weeks or more. And you can see in the wake of the 08-09 downturn, that's the big gray bar in the center, we had a dramatic spike. In fact, by 2010, about 45% of all those unemployed had been long-term unemployed. Our belief at Fifth Third is that we lost more than 1 million workers, simply dropped out because they were long-term unemployed and were unable to re-engage in the workforce. It would appear that today we have far less to worry about. We're at more or less normal levels of the percentage of unemployed being long-term unemployed. It's 19% is the last number, but that's up from 5% 2 months ago, 12% 1 month ago. So it's rising. What's the next move? Well, if you think back on the chronology of the pandemic and the lockdowns, a huge number of layoffs occurred in late March and through the month of April. If you add 6 months to those, you will get to the point where by year end, we expect more than 50%, a record number of those unemployed for post-World War II history, a record number of those, percentage of those unemployed will be long-term unemployed. So we think this bodes very poorly for our ability to grow our workforce, because we're simply going to have too many people who ultimately drop out of the workforce or can't be gainfully employed. Interestingly, we at Fifth Third have reached out to SHRM, the Society of Human Resource Management, that's the trade association of HR professionals, to try to work with them and help HR professionals understand that sorting resumes, a typical online job opening might get 250 online applications. Sorting by discarding people who've been long-term unemployed, which we believe may be a practice, is not the ideal way to optimize talent. And so we're trying to be part of the solution, having identified this problem. We also, of course, have had this explosion of government debt. This is the other side of the fiscal stimulus. This is obviously worrisome. We do believe there's a cost to rising deficits and outstanding debt, federal government debt rising as a percentage of GDP, roughly our national income. But we think those costs tend to be small costs in any given year. You can't argue that it's caused interest rates to rise. You can't argue that it's crowded out private sector borrowing. You can't argue that it has spiked inflation. But what it does do is erode confidence in the future. And that confidence erosion has a cost. That cost shows up in reduced capital investment. When businesses are less confident and high levels of debt are associated with lower levels of confidence, when businesses are less confident, they are less likely to invest for the future. Over time, that's a negative. It means you'll have lower productivity growth, which is one of the markers of how you build societal wealth. So there's going to be a cost. It's not a cataclysmic cost in any given year, but it's a cost nonetheless in shaving growth by 0.1% each year over time, and compounding, that does make a difference. The pandemic has, of course, disrupted the election probabilities. The red and blue, we use red, of course, for President Trump, blue for Vice President Biden. These are the betting market odds of a winner. You can see of a victory. You can see that prior to the pandemic, the betting markets, at least, made President Trump a almost surefire bet or enormous lead in the likelihood that he would be reelected. That flipped during the pandemic, and of course is widened out today. These betting markets are not terribly efficient markets, but they certainly reflect the aggregate of poll results today. It's not just the change in the White House, it's very critically the change in the Senate. The blue line here represents odds of a blue sweep. Again, it changed during the pandemic from a likelihood of the Republicans continuing to retain control of the Senate, and most of these odds also reflected the likelihood that the Democrats would retain control of the House. Now we're looking at the probability, according to the betting markets, of a blue sweep. Well, this is important because that blue wave scenario is the one that really has the most potential impact for the investment markets and to some degree the economy. By and large, the two cases that didn't involve a change of Congress were cases that weren't as dramatic. Presidential elections, of course, matter, but they don't always matter that much to aggregate GDP growth, to interest rates, to the level of the U.S. dollar versus foreign currency. Those are the things that tend to determine where, for instance, stock market prices are in aggregate. Of course, there are differences by industry. You know, the classic example is looking at fossil fuel companies versus alternative energy companies. That will have a lot to do with economic outcomes, but the market in aggregate is so broadly diversified, it tends to float more with direction of dollar-adjusted GDP and interest rates providing a level of valuations. So we did see that in some case of divided government, either a status quo election where the Republicans kept the White House and the Senate, but the Democrats kept the House. That's case number one. Or in the case of a Democratic White House win, but a split Senate, you still had some areas of agreement, infrastructure spending and reshoring of manufacturing. We'll talk more about that. And so, but by and large, you couldn't do any policy through legislative action that was terribly disruptive because you needed to meet in the middle and compromise. There was, of course, room for action by executive branch order. We saw that in President Obama's second term. We've seen that in President Trump's term in office. And that can certainly set the tone, but it's not as dramatic as legislative action. If we are indeed in for a blue wave, that does open the door for legislative action. Some of this will be deeper regulatory impact on energy, healthcare, financial services than you would get simply by executive order. But some of this is through the prospect and frankly likelihood in this scenario of higher taxes. Now we do caution, higher taxes obviously have an impact on investments. The one that we think would be most dramatic would be the proposal on the Democratic platform to eliminate the favorable treatment of capital gains. They'd be taxed like income tax and again at a higher rate. You know, this is a platform. It doesn't necessarily translate into actual legislation. We think directionally there's probably some move in that direction, but some of the scenarios that are being kicked around are less likely. Even if the Democrats control the Senate, there are a number of moderate Democratic senators, say a Senator Joe Manchin from West Virginia. To win those senators over to any new legislation is going to require some room for compromise. Now, of course, if you get 54 or more seats, say a Democratic, all bets are off and you can see much more radical legislation. I'm not saying radical is good or bad, but these are things that can be more unsettling and cause greater volatility to the marketplace. It's simply too early to know. This is what we're watching for. A Democratic win of the Senate, however, does open a very important door. It eases the process of confirmation by Senate. In Washington, it's often said that personnel are policy, and having control of the various committees and the overall Senate really opens the door for a little bit more aggressive policy moves, progressive, to use a name that that might be more disruptive, create greater change and volatility than would otherwise exist. So it's not just legislation, it's this personnel as policy, who can be appointed within the federal government of those appointees needing Senate confirmation. What we think is most interesting is to focus on when we get to the other side. We will get to the other side of this election. We will get to the other side of the pandemic. What's it going to look like? Well, the long view, of course, is the recognition that downturns, painful as they are when you're in them, tend to be relatively short-lived and small relative to expansions. The chart you see before you, the blue lines are periods of negative GDP, periods of recession. The green line, the green area is the size of the expansion. How much do you add to GDP during expansions? And we don't yet have the official data for this downturn. It's likely to be about a 10% loss to GDP, so that will be more severe than anything you see on this chart from post-World War II history. But we also think that that freeing up of capacity, a lot of workers available, a lot of industrial capacity available, helps set the stage for a long expansion in its wake. That's the typical pattern. We think that that pattern will be followed even after this very unusual and very deep downturn. But this is also going to result in policies that have been disrupted, industries that have been disrupted, geographies, employer-employee relationships, as well as a really great opportunity for the US economy and manufacturing. This has been a very disruptive event, even if it's going to be a fairly short-lived event by the standards of deep recessions. We see the pandemic as not really starting new trends in the US economy, but accelerating trends. It is a supercharger of existing trends. And we'll start out with the policy examination. This is the balance sheet of the Fed, a result of asset purchases. The Fed had already been doing asset purchases and growing its balance sheet in the wake of 08, 09, but look how it's accelerated. This is what we see with virtually every way we look at the pandemic impact. It's not starting something new, it's accelerating what already existed to wholly new levels. It's true of asset purchases. It's also true of the Fed's new policy framework of keeping interest rates lower for longer. This is a really big change. Fed Chair Powell announced it with the September press conference. The Fed is doing something very different. As you know, our central bankers have two mandates, a dual mandate: maintain price stability, traditionally viewed as fighting inflation, more recently viewed as fighting deflation, and promoting full employment. To do that, they've tended to focus on that inflation metric and to start to rein in monetary policy once you got to 2% inflation. They were targeting a 2% level of inflation in their metrics. They've now done a really quite dramatic policy shift. It's kind of lost in the dullness of Fed speak, but the Fed is now willing to tolerate inflation above 2% for an extended period. That's very new. They've also suggested that they will not tighten monetary policy until not only do you have inflation above 2% for an extended period, but you get back to full employment. One of the things that's interesting to us is the tone of the Fed. The Fed, some of you know, several of the regional Feds, Atlanta, Minneapolis, and Boston, embarked on a new racism and the economy project. There is legislation proposed in the House that in the event of a blue wave might see the light of day. It's called the Federal Reserve Racial and Economic Opportunity Act. That would also add a third mandate to the Fed of trying to combat inequality. That's a poor mandate for a central bank. It does not have many tools to do that. But Fed Chair Powell has really signaled his interest in doing what monetary policy can do. And what it can do is promote red hot labor markets, like what we saw in 2018 and in 2019, by keeping interest rates lower for longer. That helped build equality of income. It helped build job opportunities across racial lines, across gender lines. It made corporate America dig deep to find talent. And I think that's something that the Fed has, at least in the back of their mind, with this new policy. And we'll talk a little bit about that. Lots of disruptions in different industries. We have a placeholder here of learning from home and having, reminding ourselves that the education markets may not be the same after this. Millions of students are learning from home or are in various kinds of hybrid models. This is impacting not just students and the way of teaching, it's impacting parents. One of the things that has caught our radar, has been on our radar screen, a area of concern, is a decline in 35 to 54-year-old women in the workforce. They're leaving the workforce. This is not unemployment, this is dropping out. Our conjecture is, and this has been supported by lots of anecdotal evidence, that increasingly with children learning from home, of a certain age still need parental supervision, and very often it's women of this age who we believe are dropping out to supervise their children. The problem with that is if this is not what they want to do, again, if this extends for a period, you have long-term unemployment, it's hard to get back in the labor force. And there's some innovative strategies being discussed to combat this, but this learn from home model is going to change education. We will, of course, go back to some degree of normalcy, but it's going to cause a large question about how can we economically educate people. And certainly there's been a lot of talk over the last couple of decades about bad value for the dollar from college tuition. We think home-based learning, online learning is going to accelerate from here. It's not just learning from home, of course, it's spending from home. This is an interesting chart for us. E-commerce sales as a percentage of total retail sales. Of course, this has been growing for decades. That's no surprise. What is perhaps surprising is that we went into the pandemic with e-commerce at only about 10 or 11% of total retail sales. Look how it spiked in just a period of months, up to about 16%. This suggests to us that we've conquered new territory here, and we increasingly hear anecdotally of people who've bought homes online without seeing the homes, people who have bought cars online without actually going to a car dealership. I did that myself. This is breaking retail sales, e-commerce into high-ticket items that typically weren't impacted. I don't think there's fully going back from this. We will retrace some of these e-commerce percentage breakthroughs, but not all of them, and I think it's reinforced this trend. No surprise on this one. Working from home, interesting. This is data. There's very little data and very little formal studies. The state of Oregon, the Labor Department there, did a study. We think it's representative of what's going on in the US. We've had work from home going on for a while, 5-6% of employees. By their projection, and we think this reflects national trends as well, about a quarter of all workers who of those employed at the peak have worked from home. That's an enormous number, particularly when you consider that not everyone can work from home. Not every industry is suited to this. In fact, the University of Chicago recently did a study that suggested 36% of jobs could ultimately be work from home positions. So if we went in a matter of months from say 6-7% all the way up to 25-26%, when the total potential is only 36%, that's incredible. That's a big shift. And like e-commerce, some of this will give back when we get back to normal. There'll be somewhat of a return to the old ways, but it'll never be the same. And corporate America has realized this is at least flexibility here. Hybrid models are a viable option, even if work from home is not a complete solution for every worker. Well, if you've got trends like working from home, it's got to be disruptive to transportation. And we give a bunch of charts here. Upper left is public transit ridership. You can see it's cratered. This kind of thing tends to be self-fulfilling. When you lose public transit ridership, services tend to be cut back, which makes public transit ridership an even less attractive option. And the new equilibrium, wherever that is, will certainly be at lower levels than pre-pandemic, at least for many years to come. It's even impacted ride share services like Uber in the upper right. Lower left, passenger miles. We're seeing a substantial return of non-business travelers, but business travel has changed. Non-business travel, leisure travel is surprisingly robust considering where we are in the health cycle. But airfares have gotten really cheap. That's brought people out. Hasn't brought business people out. That is, it wraps around liability concerns, for instance, and businesses are going to look to explore cost controls going forward and how can they substitute online meetings for in-person meetings. So we think even post-pandemic, airline travel is not going to be what it once was. Again, eventually we'll get back there, but many years from now. Look at what has rebounded, lower right, automobile sales. This we think is quite telling. We are still an automobile nation. And for various reasons related to the pandemic, we think this has only been reinforced, and that any mass migration away from automobile ownership has really been stopped dead in its tracks, and perhaps for a very long time period. This, of course, is impacting real estate. We have REIT performance as a proxy here for office REITs and retail REITs. Obviously, big setback for those because of a tremendous amount of disruption in the industry. But some of this disruption is simply where people are choosing to move. There's a big movement from urban to suburban. Some of this is simply demographic trends that were in place. The millennial generation have increasingly had kids and want more space than urban settings. But now it's coupled with health concerns and the flexibility through work from home to be farther from traditional offices. And where those offices are located are changing. This is data we get, a survey done by the Site Selectors Guild. This is the trade association of site selection professionals. They have gone away from recommending large urban core, big cities, and they're moving to recommending corporations seeking new space or moving space do so in the suburbs and also in mid-sized cities. Some of this is also a reflection of desires to move to different types of areas of the country. We get data from U-Haul, has a list of, ranks the 50 states by likelihood of people to move to those states. Number one move destination is Florida. Bottom destination and really a net outflow is Illinois. You'll see, I'm afraid California is very close in there as well. We also observe this is, what's driving this? Well, some of it is, there's a broader observation, not a perfect observation, but low state taxes are part of the incentive. And part of the incentive is likely weather. You see in the bottom 5 U-Haul growth states, you have 4 of the 5 have reasonably harsh winters. And you'll see in the top 5 destination states, the growth states, you'll see a very disproportionate number of warmer states as well as low tax states. This is going to put stresses on the economy, notably for the handful of states that have underfunded pension liabilities. This is something where everyone has known it would sooner or later cause a problem. I think it has gotten to sooner. And of course, Illinois, which has been my home state, is the poster child for bad governance in the United States with very deeply underfunded pension obligations. And couple that with people moving out of the state, that's not a really good combination. We don't know how this will play out exactly, but we think it's going to be at least a headline maker at a national level, if not actually having an economic impact. Lots of movement around. And we talked about the challenges of businesses are going to face with all that kind of volatility. There's another challenge. And again, this is one that has been a long-term trend that is accelerating the pandemic. And that is the tightening of the labor force. In the United States, we had the benefit of the millennial birth boom. Millennial birth rates peaked in 1990. Those folks are 30 years old. They're mostly all in the labor market. If we're hiring now from people, say, born in 1995, 25-year-olds, those birth rates were 20% below the millennial peak. And birth rates today are 40% below the millennial peak, the workforce of the future. We have a permanent labor shortage looming in the United States. When we have seen corporations try to entice people to their companies and to stay at their companies, one of the ways they do that is through benefits. And so we use mental and behavioral health initiative benefits as just a proxy of ways to think about this. But we think it's much more profound than that. We believe that in a period of tighter labor and a period where people have really focused now on stability and health concerns, employers are going to have to more fully embrace the wellness of their employees. There's some embedded good news in this, that we might be able to help over 65-year-old workers stay in the workforce. Working parents, I mentioned before, the 35 to 54-year-old women who are dropping out of the workforce. Maybe there are ways we can keep them in the workforce. And then this big area, and this was referenced in my biography with the book, marginalized workers, most notably the 19 million Americans who have a felony conviction on their record. Bringing those workers into gainful employment is possible, but it requires a kind of wraparound services and an embrace of employers. It requires corporate America to dig deeper to try to attract and retain employees. And we think that is going to come by necessity. We would add this overlay today of capitalism being challenged to help solve social problems and societal problems. We note specifically to the issue of criminal records, 1 in 3 Black men in America has a felony conviction. If we cannot offer employment to people who have, yes, made a mistake, but paid their dues, done their time, if we can't offer opportunities to them, we'll never get to this point of equality of opportunity that, of course, is our national aspirations. So we think this is going to be driven by political factors, but the reality is it's primarily going to be driven by the absolute necessity in a time of workforce shortage. American corporations are going to have to be more involved in talent acquisition. Let me end on one other concept, and this is one that's important and one that I think is really good news for the U.S. economy, and this is the concept of bringing manufacturing jobs back to the United States. One reason it's so important is it's so likely to happen is because both parties can agree on this, one of the few areas of agreement. The first thing to understand is on the chart at the left, US share of global manufacturing employment, we lost a lot of jobs. We lost our place as a major manufacturing power in many ways. This percentage of manufacturing share, employment share, that's reflected in the 2000 to roughly 2010 period, a loss of 5 million jobs in the US. We didn't lose them because of technology. Technology always destroys jobs in manufacturing, but the productivity gains that come with that create more wealth and more demand for other manufactured goods. That's how it's always worked for hundreds of years. That's how we believe it will continue to work. As evidence of that, the period where we lost 5 million jobs in manufacturing, look what happened globally. We gained 35 million jobs away from the US. So this tells us that it's not a matter of technology eradicating wholesale jobs, it's cost structures dictating where those jobs occurred, and the cost structures have changed. We get data from produced by the Boston Consulting Group. That's reflected in the chart at the right. This is manufacturing cost competitiveness. It's indexed to the US. So you'll see third bar in is the US is by definition 100% of US of cost relative to the US. If you're going to offshore manufacturing jobs, you'd want to do it where it's cheaper. And if you look at the big 5 export nations, China, Germany, the US, Japan, South Korea, only China is cheaper than the US, and it's not cheaper by much anymore. It's only about 5% difference. That's something that could be easily wiped out by a shift in the dollar, for instance. So that is that game is over. That big, as Ross Perot, for those of you of a certain age would remember, the giant sucking sound of jobs going to, abroad is gone. That's behind us, at least to China. And then if you look at where it's still relatively cheap to manufacture, the 5 cheapest manufacturing destinations are on the right, the 5 right-hand bars. For the most part, they have much lower capacity. Malaysia, Indonesia, we hear people say things like Vietnam is full up, Thailand. Yes, Mexico has possibilities still. We know about those for nearshoring to the US. India has a real opportunity there, but it's one that's existed for India for a long time, and they haven't been able to capitalize it. We're not saying it's back to 1948 America, when half of all manufacturing jobs were in the US, or half of all jobs in the US were manufacturing, but some are coming back, and it's important that they're coming back because they have an outsized impact on the US economy. Economists talk about multiplier effects. Every dollar of value add in manufacturing, it's said, traditionally people believed, created $3 more of GDP. Every manufacturing job created 3 more service sector jobs in its wake. Most economists now believe that that 3 multiplier is too low. It should be something more on the line of 7 or 8. time. So it's very important for the U.S. economy. It's a real opportunity. We have a ways to go. We have infrastructure challenges. We've lost some industries for good, can't create a cluster. But there's a real opportunity here, and I think it's one that we should be sure to capitalize on, and will be very important to many of our businesses as well. With that, let me ask Michael to come back on, and we'll see if there are any questions. Yep. Or we can read our disclosures and definitions and keep our attorneys happy.
Thanks, Jeff, so much. I really appreciate it. As much as I'm sure those attorneys do great work, we'll skip the disclosures. Thanks for this. We've got just a couple of minutes, and so I'll try and kind of pull these together. But one of the questions was just more broadly the continued disconnect between the economic impact of COVID, loss of jobs, and the performance of the stock market, right? And one of the questions was, or highlighted that, 5 of the largest tech companies comprise something like 20% of the S&P now. So it looks great if you're one of those big tech cos, but is it the smaller companies that are taking on the smaller unlisted companies? And maybe if you can just talk about that disconnect. Is it longer term investing perspective? Is it what is that? What is that?
In part, it's a longer term investing perspective. The markets are not looking at the next 6 months or a year. They're looking years out. And obviously, it is not unreasonable to expect large tech companies to continue to have some great growth opportunities in this. Some of it is extraordinary low interest rates. At what rate do you discount those future earnings? And it is true that smaller cap companies have not seen the same level of recovery. It has not been an equal recovery. And those kind of disruptions do take their toll on the real economy and the lives of people. But over the long term, I think that the markets are having somewhat of a reasonable expectation that, we're going to get back. Maybe they're a little ahead of themselves, one could argue. On the other hand, these interest rates are so low and so likely to stay low that you'd be hard pressed not to say valuations shouldn't reflect those low rates as well.
Yeah. And then something that you and I had mentioned just quickly before the presentation was this recent sort of regional fracturing within the United States. And so one of the questions was, as you look regionally, whether it's state by state or region by region, maybe the area of the United States that is better equipped to rebound quicker, and an area of the United States that's going to have a harder climb or a longer climb back. What does that look like from the
I'm sorry to say this because it does negatively impact California, but states that are losing people, that's a challenge. Now, California is blessed with incredible weather, scenery, educational institutions, some great, and it's hard, particularly for that kind of talent pool to not but help to support an economy. One of the interesting things, and I'm really not trying to talk our book as a historically Midwestern bank. I'm not a Midwesterner. But it is interesting. Some very prominent economists, I'll throw out the name of Nancy Lazar. She's always the 1 or 2 ranked economist in Wall Street. She talks about middle America as the big winner here, largely on reshoring of manufacturing and some of the opportunities. And the fact that you don't have to live in Silicon Valley to be in tech anymore. So that kind of spreading out can very positively impact some of the sort of the middle America states, if you can get through the winters, and then in the Southeast, we've been expanding our presence, for instance, in Greenville, South Carolina. That's an amazing manufacturing center growing in the United States. I believe the world's largest BMW plant is in Spartanburg, South Carolina. Those are regions of the country that are seeing really interesting growth. The Carolinas. Florida. So it is, I think, an evening out of the economy. It's no longer going to be so focused in California, in New York City, the Beau-Wash corridor. So I think those will be the generic changes.
Yeah, I like the evening out. That's a great way of putting it. So I see the clock's just hit 5 o'clock. Jeff, I'd like to thank you again for your time and the insights today. Really, really helpful, I think, for the audience. I'd like to thank Dan Moss and the Fifth Third team as well for all the work putting today's event together, today's presentation together. To our viewers, obviously, thank you for joining ACG Los Angeles this afternoon. And with that, we'll close the program. I wish everyone continued health. Jeff, Dan, thanks again.
Thanks, Michael. Thank you, Dan.
Take care.
Thanks, everyone.
Yep. Bye-bye.